Welcome to the weekly update, where I'll go through the action in the market for the week of March 27th through the 31st, and then we'll see how things look for the week of April 3rd through April 7th. Before I go back and look at this week's session, I have a couple of announcements to make. From April 22nd through May 11th, I will be traveling. My intention are to at least post the daily video updates. I'm going to try to do the weekly video updates as well as the intermarket analysis updates and the deep dive updates. I can't guarantee that. I can't guarantee any videos will be posted, but I'm going to at least try during that time. Also, I've launched a podcast on YouTube. It's a duplicate of what you're watching right now. I have that for the daily videos, the weekly videos, and the intermarket analysis videos. A PDF is available in the description where you can download all of the slides and charts that I use in this particular video. Also, I do have a private Facebook group that you're welcome to join. If you're on Facebook, go ahead and send me an invitation to that. There's a link in the description. I'm trying to make that a little more active now. There's not very many members currently. I'm trying to get some back and forth going on, and I try to post some interesting things there as well. Also, I'm looking at doing some kind of a quiz or poll, probably on the community tab within my channel, where I might say, what do you think the market's going to be a week from now, 2 weeks from now, 1 month from now? Or is the banking crisis over? Do you think there's more still to come? Do you think we're going to go into a recession? Things like that, where people can just vote. So let's go back and talk about what happened. For the week, when we look back a week ago, we didn't get any additional troubling banking sector news. So that set the week off on a more positive tone. During the week, there was a 2-day congressional hearing over the SIVB bank failure, and I'll address that more when we go through the daily comments. There are some real worries that are still out there about the health of the banking sector, but those seem to have subsided a little bit lately. Interest rates on the week rose and the dollar fell. There was some news between China and Brazil that they're agreeing now to trade in their own currencies instead of using the US dollar. That's kind of wiping out what we call the petrodollar. And a lot of countries, because of the debt that the United States has, they don't trust the dollar as much as they used to. And so the dollar-denominated globe that we've had may be starting to shift. So that could have some longer-term ramifications. For the week, volume continues to be below average. We've been going up, and we're starting to go back up. On a daily basis, we're looking quite overbought right now, and I'll constantly refer to that as I go through the charts. But the whole time we've been going up, volume has been below average, and that is a concern. So let's go back and talk about each day. On Monday, First Citizens Bank shares, they acquired $72 billion of Silicon Valley Bank's assets, but they were able to purchase that at $16.5 billion. U.S. authorities are also considering expanding an emergency lending facility for banks in ways that could give First Republic Bank, that's been in the news a lot lately, more time to improve its balance sheet. Some people think this is what needs to happen. Other people say, wait a minute, this is a free market economy. Just let the bank fail or let the free market forces dictate what ultimately happens. Also on Tuesday, this is when we had the first day of the 2-day testimony. FDIC Chairman Barr told the Senate Banking Committee that he anticipates having to increase capital and liquidity standards for firms that have over $100 billion, adding that more regulation is needed. Of course, on the other side, people are saying, no, we don't need more regulation. We need less regulation. Then on Wednesday, the S&P was able to get back above its 50-day moving average. At that time, it was registering at 4,014. Europe was really strong that day on news that came out that UBS named a CEO that'll come in and take over starting on April 5th. Then on Thursday, the S&P was able to get further above its 50-day moving average, which now recalculated to 4,017. Then on Friday, there was some inflation and sentiment data that came out, and that was taken as positive. The S&P was able to get back above the 4,100 level. So for the week, the S&P was up 3.48% on below average volume, which is a concern. The technicals are still positive overall. We're starting to show a lot of overbought indications on the daily charts. And as I go through the weekly charts, there's also a number of overbought indications right now. The markets continue to be fixated on this inflation and interest rate scenario. Also, what's going on with this whole banking scene? Are we done with that? Are things starting to get better now, or are things going to get worse going forward from here? The condition of our trend is still weakening. The ADX is below the moving average and declining, and we're below 20. First of all, let's look at the Isabel Net charts. This is showing insider transactions. These are legal insider transactions done through corporate officers, where this tends to be bullish when we're below this black line. This next chart's a little bit scary looking because it has all these numbers on here. The takeaway that I get from this is up at the top where it says the full year has never been lower. And then right below that, it says the S&P 500 returns after a greater than 7% gain in the first quarter has never been lower after that. We're also noticing that big tech is starting to come back into favor. Companies like Meta, Amazon, Apple, Microsoft, Google, Tesla, Nvidia, they are currently 25% of the worth or value of the S&P 500, and that has been really going up since the beginning of 2023, where it was at 20%. The other thing that's being discussed back and forth is, are we going to go into a recession? Are we in one right now? What's going to happen? Looking at the yield curves, there's a really high probability, it's up around 60%, that the economy will eventually go into a recession based on this chart. This is another scary looking page. The takeaway is at the very top. They say that research is shown to sell at the last rate hike. Of course, we're never really sure when the last rate hike is. The Dow Jones returns after the last Fed rate hike in the cycle are listed down below here. The Fed balance sheet is just exploding. They added $370 billion in March, and we have the weekly change in the Fed balance sheet here. I also have a couple other charts to show you that, how it's really spiking up, which has been wiping off a lot of this quantitative tapering because now they're adding to their balance sheet. Even though they're doing it in a different way through the discount window, not through quantitative easing, it's still making their balance sheet mushroom pretty big. Current market valuation still has the market at fairly valued. Then we can look at the aggregate score, showing that we're still below this 1 standard deviation, so we're not necessarily overvalued on the whole. Then breaking this down, first we look at the market valuation models. The Buffett indicator compares stock prices to GDP. We're below the 1 standard deviation. That is fairly valued. The PE ratio model is overvalued. We're above the 1 standard deviation. The interest rate model is fairly valued. We're above the dashed line and not going up to the 1 standard deviation. The S&P reversion model is, have we gotten too far away from this middle line, which is the historic trend? And yes, we've been able to get back above that as prices advanced this past week. Now we're overvalued concerning the S&P 500. Looking at some of the recession indicators, the yield curve model is very, very high now because so many of the yield curves remain inverted. The state coincidence model still says as of the end of December, there are 16 states with a decreasing SCI. This has actually declined a little bit where we were showing a lot more problems. On average, if more than 25 states are in decline, the U.S. is in an overall recession or at least entering a recession. So this is coming back down, so that bodes a little better for not going into a recession. Looking at our market sentiment, margin debt continues to be neutral. The junk bond spread is also neutral. Then looking at the Real Investment Advice newsletter that comes out once a week, and this is freely available to any of you. Just go to realinvestmentadvice.com and click on their newsletter. They also have daily posts. Most days they post, and they have free blog posts that you can look at as well. And I cover those in the daily videos, and I just try to take some snippets out of their newsletter. At the top, it says, indicators warn of recession. Analysts disagree. This chart from Yahoo Finance says that the top 10 NASDAQ 100 stocks in 2023 account for 88% of the gains. This includes Apple, Microsoft, Nvidia, Meta, a couple of semiconductor companies, a little smaller amount, Amazon, Google, and AMD. This also stretches it out. I won't go through this whole list, showing how Nvidia is actually the strongest stock as of late. Looking at their S&P chart, this is pretty much what I've been showing. We're seeing a golden cross here, which we've seen a while now. And according to their marking on this chart, we have already reached our initial target. Doesn't mean we have to stop here, but the market is very overbought on the daily charts. And if we continue to go back down, we could get down to this upward sloping trend line, which we also see on the charts that I show you. The MACD on the bottom has crossed over positive, and that is showing improvement. This looks at a longer range, and this chart suggests that we're still in that long-term secular bull market as long as we're above this 200-week moving average. There's also a 40-week moving average in blue, and we're starting to go back above that, and they have a blow up of that down here in the corner. There's also a real high probability of going into a recession because there's so many yield curves that remain inverted. It's actually coming down a little bit, but we're at 80% right now. This also suggests that we could be getting into a recession. The blue line here is the 10 to the 3-month spread. Then we also have the 10 to the 2-year spread. These are spreads that I look at every day. This is the yield that you would get on a 10-year bond. Also looking at the 6-month leading economic index, that continues to decline, and we're down in this red area. It would suggest a recession lies ahead. Bank tightening standards continue to go up. I have some other charts to show you, but they haven't been updated lately. The small business confidence index continues to fall, and it's also hitting recessionary levels. The economic output composite index against the LEI both are declining, suggesting economic weakness going forward. When you look at trailing earnings per share, those that have already happened, you compare it to forward estimates from 2023 up through the end of the first quarter, which is right now. We have been declining, but the estimates are still going up, where the reality seem to be looking the other direction, thinking that we should be going down with the estimates. This chart just shows how the prices of stocks tend to follow the direction of earnings. If earnings are going up, stocks go up. If earnings are going down, stocks go down. These are the earnings estimates, this dashed line here. So overall, they're looking at things getting better and better. But if we really hit some economic difficulties, that could really change a lot of these estimates going forward. And at the end of their post, it says, someone is going to be wrong. For investors, the challenge will be discerning who is right or wrong. Are we going to go up with our earnings and justify higher prices? Or are we going to go down with earnings and have lower stock prices? This also looks at the LEI 6-month rate of change and compares it to the earnings per share annual change of the S&P, and both are declining. That's the reality of what's actually happening. The forecasts are just guesses as to what might happen. We're seeing a real contradiction between the two. So this shows also the annual change of the S&P with the liquidity measure, and both are declining, which could suggest further weakness going forward. Our overbought, oversold composite, it's at 73 right now, but it could still go even higher than it is now. The sentiment gauge that they use in their blog post is tipping a little bit to the right. That's somewhat positive, but it's not giving us an extreme reading. Edward Yardeni had a chart that was interesting in his latest email. He says that April is the second best month of the year for the stock market. Now, when you look at the Stock Traders Almanac, they say April is the best month. They go back to 1950, where Edward Yardeni here is going back to 1928. Says the S&P was up 1.4% on average during the month, second only to July's 1.7% average gain. Looking at the latest Investors Intelligence Survey, this is similar to the American Association of Individual Investors, but these folks talk to a different crowd. And after giving us an extreme negative reading, they're starting to come up and showing just a little bit of improvement, even though it has dropped lately. This information is about a week old when the market was hitting more difficulties. This doesn't reflect this past week ending on Friday's pretty sizable gain. Martin Pring also had one chart that's interesting. He's looking at the financial sector, where it's been under a lot of pressure lately. If this ends up being a bottom, it's making a higher bottom right here, and that could give some good support to the financial sector. Now, looking at some of the charts that I show you, here's the intraday chart. Going all the way back to Monday, we were pretty much flat overall. Tuesday was kind of a yawner, more down. Then we saw an interesting pattern. During the night, the futures were pretty strong. We gapped up and then went sideways. Same thing happened Wednesday night into Thursday morning, gapped up and went sideways. That was broken a little bit on Friday, where the futures were positive, but not all that much. But then we gapped higher and actually rose to finish out the week, getting us back above the 4,100 level. For the week, the Dow was up 3.2%, the NASDAQ up 3.4%, the S&P up 3.5%, and small caps were up 3.9%. Here's a look graphically how the NASDAQ 100 and the NASDAQ were doing well. All of the indexes ended up being up, but right now the Dow is starting to lag a bit. This is going back to the beginning of the year where the NASDAQ 100 and the NASDAQ are doing the best, followed by the S&P. Currently, all of the other indexes, even though they have small gains, they're at least positive. And going back to the all-time high, all the indexes continue to be negative, with the NASDAQ 100 and the NASDAQ showing the most in percentage losses. Then looking at our sectors for the week, energy was up. It had been kind of out of favor recently. Discretionary did well, and real estate did well, followed by materials. All of the sectors ended up being up if you just measure the 5 trading days that we went through. Then going back to the beginning of the year, the tech sector and communication and discretionary have done the best, where utilities, energy, healthcare, and financials have been underwater. Here's our relative rotation graph showing how tech and communication are the real strong areas. Discretionary has been improving, and then all of the other sectors are showing some weakness, and we have a lot of different weak sectors as we see rotation going on from one group to the other. Looking at the different sectors for the 5 trading days, real estate, discretionary, tech, materials, and energy were up the most. All the sectors ended up being positive for the week. Going back to the beginning of the year, tech, communication, discretionary have been doing the best. We have energy, healthcare, financials are down on the year. Going back to the all-time high, energy is still first place with all the other sectors being negative. Looking at sentiment, we're back to neutral. When we check out the historical chart, we did get below 25 and we've been bouncing back up above that. The VIX has also been dropping as the market's been going up. We're below 20 based on the line chart, and we're also dropping below 20 with the bar chart. The active asset managers came in with a reading of 65.15. With the up week that we just had, this next reading will probably go up, and we're starting to get extreme positive. The latest reading of consumer sentiment actually had it decline down to 62, and we're still seeing a pretty wide spread between the 2-year yield and how people are feeling. The RIDEX bear bull ratio is pretty much neutral now. We're not extreme negative and we're not getting extreme positive either. The latest reading from the American Association of Individual Investors did have individual investors being extreme negative. Now this is a week old and they have a tendency to react to what's happening. This will probably go up with the strong week that we saw. This is a new chart that I got from Shavako Capital as I was watching his weekly video, and I recommend that people do that. It's one of my channels that I recommend. This is a look at the 1 to 3 month T-bill, which pretty much you could call cash, and you compare it to the tech sector. Well, going all the way back as far as we have data, this ratio has been going down as the tech sector has been going up. And if you know anything about what's been happening, tech has been really leading the market higher. When we got into 2022, that's when we started to run into trouble, and now people were getting more into cash and out of tech as the tech sector was really suffering. We're seeing this ratio really starting to come back down, and that could be positive for the market as well. What I have on here is the Ichimoku cloud. I often call them the itchy and scratchy clouds. We use this as potential overhead support or resistance. Most of the time, since this chart is going down, it offers overhead resistance. We actually broke through with this, and now we're starting to come down below the cloud again. And that could be positive for the market. The Ulcer Index is below the moving average, showing that fear is really starting to come out of the market, replaced by complacency. Looking at the economy, this is Bloomberg's forecast for GDP. For the first quarter of 2023, they think that we'll be up with GDP. We'll be just barely up in the second quarter, which is what we're starting right now. That we'll actually go negative with GDP in the third quarter, and then after that, things will get wonderful again for the economy. This is the Atlanta Fed GDP Now forecast, where the top 10 and top bottom forecasts have us up a little bit over 2% and down about 0.5 to 0.75% overall. Here's a look at that graphically. We're focusing on this box right here. As long as it's above the black line, that's really what we care about the most, since that means GDP is positive. The spread between risky and non-risky loans is starting to go back up slightly. Looking at the Chicago National Financial Conditions Index, we are ticking back up, but we're still below this black line. When we go above that black line, that's when we really take notice. This chart has not been updated since February 6th. This is showing tightening banking standards. This also has not been updated since the last video. This is our recession indicator. When it goes above the red line, that's when we get pretty nervous. This also is a recession probability. When we go above the red line, we get nervous. The Brave Butters has also been going up lately, but it hasn't been updated in over a month. But it's not necessarily giving us a real extreme reading. This is what a lot of people are talking about in the financial media, where the Fed had been going along, making money, and then boom, as their loaning out this money for the banking crisis and situation that's happening, we're seeing a real depletion of capital that is due to the U.S. Treasury from the Fed. Then looking at inflation, the latest reading from the inflation nowcasting, we had the PCI report come out on Friday, so this has dropped a little bit in their forecast. We're seeing a little bit of a tick down in inflation. Where's the Fed at right now? After coming down with their quantitative tapering, they're now starting to really bump back up the Fed balance sheet overall as they're loaning money to banks. Here's another look at that same chart where they really spiked up, but now it's starting to come back down. Now, getting into some of our charts, the advanced decline line is positive based on price and showing some improvement based on volume. The drop-off in volume is a real concern, and that's why we're seeing a bit of a negative divergence with our volume indicators. The advanced decline ratio is still going higher with the 19 and 39 exponential moving averages. The new highs, new lows are going up higher, and we're seeing an improvement with the 10-period moving average. The accumulation distribution is above an advancing moving average. That's positive. Then looking at our trend, this continues to decline with the ADX below its moving average. The green line is on top, and that's a mistake in the slide that I showed a minute ago. So it still suggests that we're trendless overall as we continue to hug this 4,000 level for a long time now. Our rune indicator continues to be positive, and we're getting pretty much the same reading on the daily chart. The mass index is not generating a signal. Then looking at a daily chart, we're still on the underside of this upward sloping trend line. That could be some resistance. We have some pivot levels above current price. We're also very overextended. If we start to fall, we'll be looking at the 50-period moving average. If we fall more than that, the 200-period moving average and other pivot levels that we may run into. On the bottom, we can see where volume is really dropping off below average. We did get back above the midpoint of the trend channel going back to 2009. The pivot points were slightly above the monthly pivot, so that has turned positive. And we're above the 50-period simple moving average. That's positive. Our long-term trend, not quite ready to give us a golden cross yet, but getting very close. The bullish percent index, we're seeing the exact same thing on the daily chart. We're just a little below 50, but showing improvement. The Chaikin oscillator, also the same thing on the daily chart, above the dash line. That's positive, and going up, that's also positive. Chaikin money flow, going sideways more or less, seeing a little bit more improvement on the daily chart, but there is some weakness starting to creep in on both the daily and weekly charts. The force index continues to be positive since it's above zero and advancing. The McClellan oscillator is giving us an extreme positive reading. The summation index based on price is still negative but improving, as well as with volume. The oscillators, the slope is trying to turn back up. The TSI is still positive. These are our short-term oscillators. Our intermediate-term oscillators, we're still barely positive with the MACD. We've been watching that one close. The PMO is still positive. We're not turning up quite that much yet with the PPO, but our longer-term oscillators continue to be positive even though they're rolling over a bit. The Swindlen Trading Oscillator based on price is extreme positive and getting close to being extreme based on volume. The PMO was starting to roll over but now showing some improvement. We're crossing back above zero with price and just a little bit below zero with volume. But based on price, this is turning positive. The percent of PMOs that are rising, we're also seeing this on the daily chart. Extreme positive. We're also seeing an improvement with the buy signals, both on the daily chart and weekly chart. And we're starting to improve with the PMOs that are above zero on both charts. The RSI is above 50 and advancing. That is positive. The special K, even though it's declining, we're still above the long-term moving average. The Stochk RSI is starting to get extreme positive. The Williams percent R just a little bit below being extreme. The Vortex is positive with the green line on top. The Ultimate Oscillator is above 50 and advancing. That's positive. The money flow indicator was flat and still below 50, so that's negative. The Bollinger Bands are above the dashed line and advancing. That's positive. The rate of change going back 1 week, we're just starting to get into the initial area of going up too far too fast. And then going back 50 periods, we're showing some improvement with the rate of change 50. The Kopik curve, we are working off of a daily signal that's been generated. This could be crossing over positive on the weekly chart. We're still well above support with our weekly Fibonacci levels, and we're well above the 200-week moving average. Our different charts, the Heiken Ashi has turned a positive with an open candle. The Kigi chart has a black bar pointed up, that's positive. The Renko has 2 open boxes, that's positive. The ease of movement was pretty much flat going back 1 week, and we're turning more positive going back 14 weeks. We added 2 new X's on the weekly point and figure chart, that's positive. The 3-line break also has open bars, that's positive. Looking at our trading systems with the Elder Impulse system for the weekly bar, we've switched to positive, but we're still negative with the parabolic SAR because the dots are on top. On the daily charts, the dots are on the bottom. Looking at the broad market, here's the S&P, which pretty much has been chopping sideways around this 4,000 level, seeing some improvement with the mid caps and a little bit of improvement, but still lagging with the small caps. All stocks continue to be positive and breaking above both moving averages. The mid caps also showing some improvement after a recent golden cross. The small caps, some improvement, but still lagging, as I just mentioned. The Dow is hitting resistance at its 13-week moving average. The NASDAQ getting really close to a golden cross, but not quite there yet, where the NASDAQ 100 has now given us a golden cross and appears to be breaking out. The Wilshire really close to a golden cross and showing some improvement. The NYSE did give us a golden cross, a lot of weakness, but now starting to bounce back. The FANG stocks, recent golden cross and starting to break out. ARK still in an overall downtrend, has a ways to go to get to a golden cross. The biggest software companies getting really close to a golden cross. The KBW Bank Index, after just getting hammered, we're still in an overall downtrend, but it looks like prices could be stabilizing. The RSI is extreme negative and starting to bounce back up. Looking at Dow theory, the Dow's been chopping more or less sideways, seeing a little bit of recuperation in the transports. This was a concern where we're seeing more of a breakdown in the utilities, but they could be making a comeback. A look at some broad markets. The CRB index, recent death cross, but bounced up this past week. Copper, overall uptrend, and has been chopping around quite a bit lately. Gold is still in an overall uptrend, but it was down on the week. Silver also in an uptrend and up over 4%. Oil has been bouncing between 70 and 75, where we closed at 75.67. The dollar was down on the week. Then looking at bonds, we're showing some improvement with bonds, but not enough yet to give us a golden cross. We already saw a golden cross on the daily chart. We haven't seen it on the weekly chart yet. Here's a daily chart showing how yields have been pretty much going down. The MOVE index is starting to show a decrease in volatility of bond prices. Then a weekly chart looking at the US, the UK, and Germany, how overall their interest rates are starting to go back up slightly. Japan is its own story that we're keeping an eye on. Here's our intermarket analysis chart going back to the beginning of 2022. Oil still is in the lead, followed by the dollar. Gold has been showing some improvement, where stocks and bonds are showing improvement but are still negative. Seeing a little bit of a breakdown when bonds are compared to the S&P. The monthly chart of the stock-to-bond ratio shows that stocks are still in an overall uptrend, but bonds have been trying to make a comeback. Gold to the US dollar shows how gold is starting to break out compared to the dollar. And here's gold to the S&P. It did have some weakness this past week, but is still in an overall uptrend. Low volatility stocks are really starting to come more out of favor as the market climate seems to be shifting. Growth to value, still in an overall downtrend with growth, but showing some improvement, but declined this past week. The NASDAQ 100 to the S&P is getting really close to a golden cross with this ratio. The S&P 100 compared to the S&P 500, still in an overall downtrend, but making some improvement. Discretionary, still in an overall downtrend compared to staples, but trying to bounce back. Energy, still in an overall uptrend, but lately has been showing weakness when compared to tech, getting close to what could be a death cross in this ratio. Then looking at our long-term trend, where we set a low in October of 2022 based on the NYSE breadth thrust. Looking back at other times when we had that same kind of signal was very favorable for the market after that. Looking out into the future, 1 to 2 to 3 years, this has a perfect track record, but it doesn't mean it's going to be all rosy getting from here to there. Looking at our momentum studies, this is the chart that we've been looking at every day. Now, I go back and I look at 1998 to 2004 when we had a breakout above this downward sloping trend line. 2 times we had that. We were faked out both times. So we look down here at the MACD. What was it doing at the time? The MACD was actually improving, but well below zero both times. Then when we go to 2007 through 2010, the MACD was pretty much sideways when we saw the same thing, and then the market fell apart after that. Now, looking at where things are at right now, the MACD is above zero and turning back up, and price is still above this downward sloping trend line. So that's where we're at right now. This could change. We're still at that point where not enough price action has happened to take us away from this situation yet. So what's our outlook for the upcoming week? On Monday, we have the IHS Market Manufacturing PMI. The final reading will be coming out. Construction spending and the ISM Manufacturing. That'll be the big one. On Tuesday, factory orders, the JOLTS job openings. On Wednesday, the MBA Mortgage Applications Index, ADP employment change, and the trade balance. Then the IHS Market Services PMI final, followed by the other big report, ISM non-manufacturing. On Thursday, we'll have our jobless claims as usual. And then I'm unsure about Friday. Usually the market is closed for Good Friday, but I'm seeing things on the economic calendar, such as the employment situation report, which is a pretty big thing. So we'll have to see how that all works out, as well as consumer credit might be coming out if the market is open. We're still keeping an eye on the technicals. You can see that we're positive overall, even though our trend is pretty much chopping sideways. It's turning back to looking more positive, but we're starting to get overextended. We already are overextended on the daily charts. We're starting to become more overextended on the weekly charts. The markets are still fixated on this inflation and interest rate problem. And is this whole banking thing still going to continue, or is it pretty much been dealt with? And then the debt ceiling, haven't really heard much about that at all lately. And then any other Fed speak that we may get. Here is a schedule of the different speeches. On Monday, we have Lisa Cook, who will be talking, and then Tuesday, she's talking again in a virtual conference. Looking at the Stock Traders Almanac for April, this is the first time I'm showing this slide on the weekly video. It's the best month for the Dow going back to 1950, where if you go back to 1928, it's the second best month. The Dow is up 16 straight years going back to 2021. The exception was 2022. The Dow shows strength after tax day. Earnings expectations for the first quarter lead to optimism before earnings are released. It's the buy the rumor, sell the news kind of mentality. It's rarely a dangerous month, but there are 4 exceptions, with the most recent one being 2022. According to Stock Traders Almanac, they have a thing called the best 6 months. Well, that ends with April. Going back to 1950, the S&P 500 return during a pre-election year is 3.5%. During options expiration, the very first day, it's pretty much a roll of the dice there. It's up 51, down 49%. On options expiration, that actual Friday, we're up 63% of the time and down 37% of the time. And then for that whole week, we're up 70%, down 30%. This is interesting. And then the week after expiration, we're up 63% of the time and we're down 37% of the time. Then going back and just looking at Monday, April 3rd, we have pretty much across the board the same thing, with the Dow, S&P, and NASDAQ being up 61.9% of the time. Going back the last 73 years, April tends to be up 71.2% of the time and down 28.8% of the time. Then what I've done is the other things that we look at that look at the whole year, I put that on a different slide. The January barometer states that the year follows January 83.3% of the time, going back to 1950. We're currently working off of this January trifecta reading of 3.0. That was the Santa Claus rally that gave us a score of 1. The first 5 trading days were positive. That gave us a score of 2. January ended up being up for the month. That gave us a score of 3. When that happens, we're positive over the next 11 months. They've been up 87.1% of the time with an average gain of 12.3%. But if you go back for the whole 12 months, we're up 90.3% of the time with an average gain of 17.5%. Also, the markets like that we're split between Republican and Democrat, specifically within Congress. I've shifted this forward, looking at the pre-election year. For April, we're following the green line here. Historically, that has been what's happened. And then going to our pre-election year after a midterm bear, We're looking at the gray line here, which tends to show positive seasonality. We're still kind of at the latter part of this sweet spot that we never really saw that much in March, even though we were up. Could we be getting ready to hit that? And then we're on the first trading day of the month on Monday, and we follow the dashed green line here, which is the S&P 500 in a pre-election year where it tends to be up overall. Our different scenarios just for Monday, can't really go with the down one based on the daily charts because we're not trending and we're looking pretty positive, but we're overbought. So if you're super duper aggressive and you think we're going to start heading down, that's on you, but it's not what our charts are telling us. We can't go with the up one because we're overbought and we're also not trending. So we're going with the sideways trend because on the daily chart, the ADX is strengthening. It's getting a little bit above its moving average, but we're still below 20 and it's positive, and we're shifting over to positive now on the weekly chart. Thank you. I hope you found this helpful. Please feel free to check out the daily video that's already been posted. I will be preparing the intermarket analysis video as well as the deep dive video, and those will be available to you hopefully by the time the market opens for Monday's trading. Have a great weekend, and I will talk to you in the next video.